Okay, so this analysis report lays out a really strong, contrarian bullish case for BBBY.
A very strong case.
It argues that the recent drop down to around $6 is a golden opportunity.
Right.
And it's all based on, deep value fundamentals and some key technical support levels. The core argument is that the stock is just historically cheap.
The price to book and price to sales.
Exactly. PS of 0.3, PB of 0.33. They're basically saying the market is valuing the company's assets, the IP, inventory, all of it, at just 33 cents on the dollar.
And that's a fantastic starting point. I mean, anchoring the thesis on those multiples is the right move. But it immediately brings up the big question, doesn't it? If it's so obviously cheap, why is it trading here?
Well, I think the report tries to answer that with what they're calling the rebrand catalyst.
Okay.
They draw a very sharp line between the old bankrupt company of 2023 and this new entity, which they're calling a debt-light, asset-rich tech company.
So the current price is just market fear left over from the old days.
That's the argument, a total mispricing.
And I think that's where the first real opportunity to strengthen this analysis lies. To maximize the impact of the valuation argument, the report needs to spend more time connecting those low multiples to actual future operational success.
Okay. So the weakness right now is that it sort of treats this new debt-light status as a given. Like it's a fact, and the market will just catch up eventually.
Exactly. It's presented as a self-evident conclusion, not a supported transition. The deep value claim is leaning really heavily on a static balance sheet.
Which doesn't really explain how those assets are going to generate, better profits tomorrow.
Right. It doesn't justify that 80% upside they're projecting. It's a bit of a leap of faith.
So the suggestion is to build a better bridge.
A much stronger, logical bridge between the current low valuation and that projected upside. And you do that by integrating some specific forward-looking metrics that are tied directly to the rebrand.
You have to show the mechanics of the transformation.
The mechanics. Yes, that's the perfect word for it. Don't just tell me the balance sheet is clean, show me how that translates into monetization.
Right.
So for example, instead of just saying the new company owns the most powerful home brand in America, give me some specific quantifiable examples of what that means for revenue.
How does that brand power actually turn into dollars?
Precisely. They highlight the debt-light structure. Okay, great. How does having zero debt service give them a direct CapEx advantage that their competitors just don't have?
You could actually model that out. Show how the freed up cash flow lets them invest in, say, new inventory software, or an AI-driven supply chain that a competitor who's servicing legacy debt can't afford to build.
Now you're talking. And you can get even more granular. Detail how using that newly acquired IP or tech will lead to projected gross margin expansion.
For instance, if they can recapture just 1% of market share from, say, two of their biggest rivals.
What does that specific margin improvement look like? That's the kind of forward-looking detail that makes a sophisticated investor really buy into those $10 or $11 consensus targets.
It changes the entire argument.
It really does. It moves it from, hey, this stock is cheap, to this stock is cheap, and here is the step-by-step quantifiable plan for unlocking that value.
And that focus on operational mechanics leads us, I think, directly into the second key point. Bolstering the credibility of the entire analysis means you have to acknowledge the counterarguments. You have to explicitly address the operational risks that could completely invalidate the bullish thesis.
And the report does make a powerful case on the risk-reward, to be fair.
Oh yeah, it frames it really well. A 2-to-1 ratio in favor of the bulls. You've got $5 or more of upside versus maybe 2.5 of downside. Looks great on paper.
But
the report defines that downside risk almost exclusively as a technical retracement.
to the 52-week low.
Yeah, down to about $3.50.
And that's the weakness. That is absolutely the weakness. Defining risk by a line on a chart completely sidesteps the single most important question a skeptic is going to ask.
Which is?
What if the rebrand fails? What if the execution, the actual integration of these powerful brands and the shift to a tech-first model, what if it just falters?
So by not addressing why the market is pricing it this low in the first place,
Which is almost always about execution risk.
the whole bear trap narrative feels a little incomplete, a little fragile.
It's like the market is worried that the construction crew rebuilding the house might not bolt the new frame on correctly.
That's a great way to put it. And the report needs to show us the safety inspection report.
Exactly. The market is worried about the transition itself, not just the technical dip. So the suggestion here is to introduce and then systematically refute, or at least mitigate, the biggest operational risks.
You have to show the reader that you've thought about this, that the risk has been fully considered and priced in.
Right.
But how do you do that without undermining the core bullish argument? That's the tricky part.
I think you have to frame it as a sign of strength, like due diligence.
I agree. Maybe add a dedicated section. Call it something like, what would invalidate this thesis?
Oh, I like that. It forces you to tackle the bear case head-on.
Yeah. So you could explicitly discuss the challenges of integrating a huge brand name and, these complex inventory systems without losing customers along the way.
And instead of just a vague line about competition,
No, you get specific. Address the competitive landscape. What if Amazon or Walmart decide to get aggressive and respond to this rebrand? What is the specific competitive advantage? Is it pricing flexibility from the debt-light structure? Is it faster scaling that neutralizes that threat?
and I think crucially, you need to set clear, quantifiable thresholds for performance.
KPIs, key performance indicators. You set tripwires that, if crossed, would genuinely change the narrative.
Can you give us an example of a KPI like that?
Sure. So instead of just promising future profits, the report could say something very specific. Like, our bullish thesis is invalidated if quarterly revenue growth from proprietary IP falls below 15% year over year.
Or
If customer acquisition cost, CAC, rises above $50, which would indicate the integration is failing to find synergies.
that completely changes the conversation.
It moves the downside risk away from just being a technical floor on a chart and into the realm of actual business performance. It makes the entire analysis feel so much more robust and trustworthy.
It converts a potential weakness into a source of analytical strength.
That's it.
So that makes the risk-reward proposition feel truly earned. You've addressed the fundamentals, the potential pitfalls, and now we get to the final piece, the action plan.
The execution.
Sharpening the technical analysis and the action plan is so key for turning this from a good idea into a tradable one.
And look, the technical section is strong on the diagnostics. They've done the work. They correctly identify that $6 to $5.90 zone as a massive support area.
They see the RSI is likely in oversold territory.
And, most importantly, the observation that the low volume on the drop suggests exhaustion. That's a classic signal. They've defined the opportunity very well.
I agree. That insight about low volume being a sign of exhaustion, a potential bear trap, that's really the core technical insight driving the whole snapback rally idea.
It is, but the weakness is what comes next, the resulting strategy.
Watch for a hold above $6.
Ugh, watch for a hold? For an expert listener who's ready to act on this, that is just way too vague. It lacks any real precision.
It leaves the actual entry confirmation totally open to interpretation. So you have this high conviction thesis built on data,
But a low precision execution plan. It's a disconnect. We need to define that trigger precisely.
So the suggestion for improvement is to use all those great technical signals they already identified, the RSI, the volume, the support levels, to define a specific objective entry trigger.
Right. Not just general monitoring.
Okay, so let's drill down into some concrete examples here. How do we make this actionable?
Well, let's use that volume exhaustion signal. It's the strongest one they have. So instead of a passive watch and see approach, the analysis should suggest a concrete, measurable condition for entry.
Like what?
For example, the accumulation zone is confirmed by a daily close above $6.04. That was the after-hours high, achieved on volume that exceeds the 10-day average.
Ah, that's powerful, because it verifies the diagnosis.
It totally does.
If the price closes above that level on high volume, it's an objective confirmation that the sellers are tired and momentum has shifted.
It takes all the subjective judgment out of it. Or, alternatively, since they correctly identified the RSI as oversold, they could use that.
Okay,
The action plan could recommend waiting for the RSI to physically exit the oversold zone, to cross back up above 30 or 35. That gives you a verifiable technical confirmation before you deploy capital.
it makes the action plan as sharp and targeted as the initial deep value assessment.
That's the goal. You want the whole analysis to be sharp, from thesis to execution.
So these three opportunities, they really address every major component of the report. We've defined the fundamental value, strengthened credibility by tackling the counterarguments, and sharpened the trading plan.
Absolutely. And this is a very strong report to begin with. It's built on solid research.